Singhania joins us now. Let's take our conversation forward with Sunil. It's been such a great year for for investors, and Sunil's fund has done extraordinary well. Uh, if I look at any cut, 1 month, 3 month, 1 year, across the board, his schemes have given an extraordinary return. So the smile on his face now will pretty much capture the kind of returns his investors have enjoyed with him. So Sunil, fantastic to have you back on ET Now. Thank you for joining us. We were looking for a Santa Claus, and this year you become a Santa Claus for your investors.
Thanks a lot, Nikunj, for all the kind words. Advance New Year wishes to you and everyone at ET Now and all the viewers. I think it's been definitely a good 18 months. Definitely very good looking at what we started with when the pandemic hit us. So, I think those who have been positive on the Indian economy and the Indian equity markets have done really, really well.
Sunil, but for the first time in the month of December, this market has tested your nerves. And the nerves have not been tested in this bull market so far. Markets are down 10% from the recent high. We've seen a bad patch of volatility. So is that the new normal? The kind of price action and volatility what we've seen, which has been two-way, are we in for more of the same in 2022?
So, Nikunj, volatility has always been the order of the day as far as equity markets are concerned. Obviously, no one likes deep correction because inherently we are all, bulls as far as the equity markets are concerned. But actually, if you see, in the run-up to like maybe October, we were in a phase where, money making was becoming too easy. IPOs were getting lapped up. They used to open 2-3 times their IPO price. A lot of broader market stocks used to hit new highs on a daily basis, and everything was like, there's no tomorrow. So to that extent, I think it was very evident that there has to be some correction. Obviously, the correction was, it lasted longer than what it has over the last 2 years. And, the 9-10% correction in Nifty led to some of the broader market stocks falling even 20 to 30%. So to that extent, yes, investors were a little bit nervous, but I think this is something which we used to be witness to many times before. So I don't think it's unduly worried. I always say this, that markets are like cardiogram. As long as they are up and down, we are all hale and hearty and pretty okay. So I think to some extent this correction was welcome. It leads to a little bit of stability as far as price action is concerned. For long-term investors, it also gives an opportunity to create a portfolio at peace rather than get into it and chase stocks. So we were not unduly worried, and we are not unduly worried. I'm not saying that we are at the complete end of it. Maybe we'll have more bouts of volatility, as you rightly said. News flow globally is, very intense nowadays. As individuals, we are, exposed to news flows on a second-to-second basis. And we want to react to the news flow at the same time in the same direction. So, I think equity investors have to brace for volatility always. Maybe the volatility is slightly increased, but so be it.
Sunil, a slightly broader question, and this perhaps is not about Indian markets or equity as an asset class. We're calling 2021 as a year of fascination and imagination. Fascinating things have happened in the digital world, whether it is crypto or NFT. The sheer wealth which has got created in other asset classes also, the kind of excitement what we've seen in other markets also is unparalleled. What does that mean for the aggregate picture for 2022?
So Nikunj, you are right. I think world has become more dynamic. I think disruptions, new concepts, new way of living, obviously is the way of life. You forgot the meta world, which is a virtual world, which is as fascinating. It looks like a sci-fi movie, where you virtually buy a house, virtually have friends, virtually buy paintings and so on and so forth, and which is where the NFTs of the world and all come into play. So it is interesting, but at the same time, Nikunj, we should not forget that some of the big gainers have been some old boring businesses, So you have steel and textile and so many other boring businesses, in fact, give you more returns than all these high-flying themes. So while we have to be aware of all these themes, I think blindly investing in them at whatever valuations is not going to be good for the investors' financial health. So I think obviously, sanity in terms of what one is paying for is as important as the theme you are playing for.
So what does that mean? I mean, in case we see a reversal or adjustment in the NFT world or the crypto world, could that impact risk appetite? Could that impact equity as an asset class? They say that it's a flat world and everything is connected. I'm asking you this question is because if there is a risk off moment in other asset classes, could that impact equities in general?
So in the near term, you are right that it does impact, but I think overall over a period of time, investors do adjust. So I think the investors who are there in this new age, I would not say themes, but products which the traditional ones don't understand and don't want to understand are very different. So maybe crypto might turn out to be a great asset. I don't know. At least I don't understand it, so we stay away from it. NFT is another thing. The concept is superb, but how do you value them? We don't know. But luckily, in crypto, it's mass retail, so the amount invested is very small so far as yet. On NFT, it is, I think a very, very handful of investors who are therein. But again, when we look at them and when we read a lot of things written on them, I think the only reason why investors are investing in them is because they believe that the price tomorrow will be more than what it is today. There is no fundamental justification as yet which is given for any of these new age sort of so-called, I would not say called investment instruments, they are trading instruments. But yes, in the near term, if people lose a lot of money in one asset, maybe if the investors are common across asset classes, then it might impact. But at least my view is that it's not going to have too much of an impact on other asset classes.
I'm just reading the return what Sunil and his funds have given. Abakkus Growth Fund 70%, benchmark 35%. Abakkus Emerging Opportunity Fund 94%, benchmark 37%. These are fantastic returns. So, like a table thumping applause to Sunil and the kind of returns what his schemes have given. Sunil, one of the reasons why you've done so well is because you took concentrated bet in IT, Mastech, Root Mobile, your good old favorite HCL Tech. Where is IT headed now? And in the light of what we've heard from Accenture, what is your view on that sector?
First of all, thanks for the compliments, but just a disclaimer before I answer your questions. I think last 18 months returns were very abnormal. Please don't expect those kind of returns going forward. That's a disclaimer to all our investors and prospective investors. Coming to IT services, Nikunj, IT services is one sector where Indian companies have global competitiveness and global expertise. The other thing which is happening in the IT world is that a lot of companies still have to adopt the new age way of basically digitizing their whole operations. So for example, cloud. Everyone wants to move to cloud. There is some data point which says that less than 25% of the companies have still adopted cloud. So 75% more companies have to adopt to cloud. And when they adopt to cloud and when they move to the Azures of the world and the Amazon Web Services of the world and the Oracles of the world, they will need companies who will assist them to enable the movement. And that is where IT services in India would come into play. Similar is the digitization world. Similarly is the data analytics world. When we speak to IT services companies, I think demand is the least of their issues. I think the issue right now is more supply, more getting people. So we are in a phase where next 4-5 years look exceedingly well for the IT services. The other thing is, Nikunj, we mentioned that, we are a little bit of the mindset where we look at profitable companies and growth in profits in the underlying assets. So IT services and some companies which were exposed to the digital world were our way of investing on a quasi basis in the new age you may say the e-commerce world or the CPaaS world and so on and so forth. So we have been lucky. We were a little early. The companies have done well. But as we move forward, we continue to be extremely positive on the IT services space. The recent small depreciation in rupee is also a tailwind. These are companies which keep on growing in mid-teens, free cash flow generating companies, a huge distribution by way of dividends and buybacks. I think, all the parameters they tick quite nicely. So we'll continue to be, overweight on this segment.
Your top 10 holdings, that list is available in public forums. Is it likely to change drastically in next 12 months?
So Nikunj, from our perspective, as long as the company keeps on, performing in line with what we expect them, we have no reason for us to get out of the company. And it's always easy to say the stock has gone up 50%, 100%, let us sell it. But we don't realize that something else which we'll buy would have also gone similarly or maybe slightly lower. But as long as the companies perform in line with what we expect or better, there is no reason for us to get out of the company. At the same time, the good thing about the Indian economy and the markets is that we are very diversified. We have presence across sectors. We have so many listed companies. The country grows because of entrepreneurs, and we have lots and lots of them, lots and lots coming up. And I think time and again, there are opportunities which come up. And as investors, we are open. We are not fixated to particular sectors. We are not fixated to particular themes. The only underlying theme which we follow is that the company should have visible profit growth. And to that extent, we are always open to invest in, companies across sectors. In fact, if you see, we have made as money in a steel company as we have in an IT services company. So at a price, every company can be a great company, and at a price, the best company might not be the best stock. So, that's a simple sort of philosophy we follow. So it's possible that a lot of them might continue to be in the top holdings, and it is also possible that some new might also be added.
Sunil, the differentiating factor for an investor in last 18 months has been for those who bought fear. I mean, it was all about going against the medical news, going against the general market mood, and if you bought fear, you've hit a home run. What will be the differentiating approach or character for an investor for next 12 to 18 months now?
So Nikunj, actually, maybe partially you are right that if you bought at the height of the fear, you made a lot of money. But even if you were an investor before COVID, you have made great returns. So both our funds were launched before COVID. So these returns are, irrespective of whether you got in at the height of fear or before that. I think the bottom line is that if you are investing in a country which has visible growth rates in terms of the GDP, I think the corporate profits will definitely grow faster than the GDP. And, your returns on a compounding basis will do phenomenally well. The problem is that we end up, sort of comparing our returns bottom to peak and peak to bottom, and therefore we get fearful and greedy from time to time. So my view would be that, for an investor, they should have reasonable expectations. And I think if you have a 4-5 year time horizon, there is no reason to believe that Indian equities cannot give you mid-teen kind of returns. So obviously, if you are very smart and if you can time the market and if you were brave enough to put everything in at the height of the peak, I don't think there were too many of them in terms of the investors. But if you are able to do it, you can do it. But otherwise, keep it simple, be positive and be invested.
Sunil, so let's do a very broad park assessment. We are approximately a $3 trillion economy, and the market cap is approximately $3 trillion. How much of the market, to your mind, is in high value euphoria zone? How much of the market is in hold zone now where you don't want to sell? And how much of the market is looking extremely attractive to you that you are hunting for ideas?
So, what you are saying is definitely time and tested. The market cap to GDP ratio time and again has been proven to be a key indicator. But I think times are changing a little bit. One is there are so many companies which are getting listed at some significantly higher than, I would say fundamental justifiable valuation, largely because investors do believe that in the next 5-10 years they would be great companies in terms of profits also. We don't know, we'll have to see it. Then there is another category of companies which, because they were doing well when the economy was not doing well between 2016 to 2020, trade at some 70, 80, 90 PE multiples. And our view is that there is definitely going to be pressure on that set of companies. Nowhere in the world valuations for companies growing at 10, 11% have sustained at 60, 70, 80 PE multiples. And therefore, I would say that it is possible that there might be an adjustment as far as the composition of the whole market cap is concerned. Textiles at one point of time used to be 25, 27% of the market cap in India. It's down to maybe 1%. So, sectors change. I'm not saying that textiles will come back to 25%. I'm just trying to give you an indication of what has happened in terms of the change in the market cap. Also, we are not looking at a significant re-rating as far as the PE multiples of the markets are concerned. But even if you are able to invest in companies where growth rates in terms of profits are 14-15%, even without PE re-rating, we can expect that kind of returns. And I think those would be great returns, given the fact that fixed income post-tax is now giving you 3.5% returns. So I think anything which is mid-teen returns, which is in line with the profit growth of your underlying investment, rather than banking on a PE re-rating, should be great numbers. Also, the GDP also will grow, right? So, if you are even able to grow at 7.5% real GDP growth, you add even 4% inflation, your nominal GDP growth can be 11.5%, 12%. So with this ratio being 1:1 or slightly more than 1, even then you can, expect to have like a low teen to mid-teen kind of returns.
Why are banks getting punished? And they're getting punished severely now. The template is economy will do well. If economy does well, banks will do well. But the underperformance is stark and it is bothering people. It is hurting investors, and especially for at least large funds which are benchmark dominated, the downtick in banks is a problem.
So you're right, the financial services sector is the barometer of the economy. And, traditionally it's been said that the banking sector normally grows 1.3 to 1.5 times the nominal GDP growth. But, I think we saw the September results for banks being excellent, and we saw how the stocks even reacted. ICICI Bank for the first time in its history maybe hit a upper circuit the day after the results were declared. However, last 2.5 months has been a period where foreign investors have been majorly on the selling side, and 40% of their investment in India are in the financial services sector. So obviously, when they sell, 40-45% of their selling has to be in the financial service sector, and this is a sector where the domestic institutions were already either equal weight or overweight. So obviously the selling pressure could not be met by an equal buying pressure. So that was one reason. The other thing is the financial services sector is getting broad-based. So earlier we only had fund-based financials. So you had banks and NBFCs which were lending. Now you have, the insurance companies, the life, the general insurance companies, you have the asset management companies getting listed, and some fintech companies also getting listed. So, even if you want to just keep your exposure to financial services sector at say 35-40%, which is in line with the index, you might have to sell some fund-based financials to buy some non-based financials. So maybe there is some adjustment going on at this point of time. Having said that, we continue to be quite optimistic. I think this fear about fintech coming in might be real, but it's not, I would say, a big threat. Largely because one, the banking sector thrives on the deposits, and as depositor, when you place deposit, you want a known name, and therefore you would be more comfortable, parking your surplus deposits in your savings account and current account in well-known banks rather than some new age fintech or NBFCs. The other thing is there is a regulatory sort of, entry barrier to this sector. And I think the third thing is that if we are banking on the economy growing, and at least that is what we believe, and we believe that the capex cycle, even on the private sector, is going to come back, there is no reason to believe that bank credit also after a point of time will start to grow. Slight increase in interest rates, frankly, are a little bit positive for the banking sector because your assets get priced faster than your liabilities. So we would be at this point of time, use this opportunity to increase our weightage in the financial sector rather than get worried about what has happened over the last 2.5 months. The other thing is, Nikunj, the Nifty fell 10%, the financials fell 15%. So it's not that, they have underperformed massively. Yes, there has been a slightly bigger underperformance compared to Nifty, but it's fine.
Sunil, in today's digital world, compression of trend and cycle has started. What used to happen earlier in 5 years is happening in 3, what used to happen in 3 is happening in 2, and what used to happen in 6 months is happening in 6 days. Which are the cycles you think are getting compressed in terms of business and stock markets, and which are the cycles you think are in for long duration?
No, I think you have exactly hit the right point, Nikunj. Cycles are definitely getting compressed. And in fact, I would add one thing, that what used to happen in the US used to happen in India after 15 years. Now it is happening after 15 minutes. So we are more integrated. And to that extent, a key parameter before we buy into a stock or a sector is what kind of disruptions can hit that particular sector or industry. We have seen how two-wheelers are underperforming, not because they are not great companies, but because of threat of the two-wheelers on the EV side. I think similar kind of threats and disruptions are possible across sectors. And therefore, one has to be very, very alert. Even on the consumption side, gone are the days where, a brand can sit on its laurels for 20, 30 years. In this age of Instagram and social media and so on and so forth, even new brands are getting the exposure, because they're reaching directly to the customers, so the D2C kind of segment is really, really booming. And to that extent, one has to be very, very careful. And I think that is exactly the reason we believe that companies which have grown at 10, 11% cannot trade at 60, 70 PE multiples, because, there's going to be massive disruption risk to a lot of these high-flying and high-valued sectors. From an investment perspective, see, we can only be alert, we can only be aware. Obviously, reading is becoming more and more important. Being aware of what is happening in the world is becoming more and more aware. And as long as you are more right than wrong, I think we are home. It's impossible to be aware of every trend and be right on every trend. Sometimes you might not be able to understand it. Like, we don't understand crypto. Maybe it might become big. Who knows? But at this point of time, we don't understand the world of crypto and NFT. And therefore, we are staying away from it. So I think being aware and doing things which you are very clear about would be the only way going forward. But absolutely right, cycles are shorter, and I think the world is getting more and more integrated.
Couple of last follow-up questions, Sunil. The hallmark point for 2021 to a large extent has been listing of internet companies, consumer tech. What could be that hallmark event or trend for 2022?
I don't know, Nikunj, frankly. I think all these new age companies getting listed obviously was a surprise. No one expected it when 2021 started. It is only in the second half of 21 that this has happened. But, my personal view is that these companies are more P kind of companies. I don't think the listed, investors would be suitable for these kind of companies, which are still in the phase where they need massive infusion of capital to pay for their losses. So that is one thing. The other thing is, I think in 2022, you will have a plethora of these kind of companies coming in for sure. But what is also important is that in the last 2-3 years, this whole concept of innovation, which was lacking in India, is coming up in a big way. And I think that's a big, big welcome change. Earlier we had a brain drain. The smart guys were going to the US and other parts of the world and doing research and innovation there. Indian companies were more focused on profitability, and rightly so at that point of time, and had become sort of the back office of the world. I think we are now seeing a gradual transformation where Indian companies and startups are also looking at some innovative stuff. So I think it's a very, very welcome change, and because of this huge funding which is available for startups, from venture funds and from PE guys, and also the government push towards setting up key segments like semiconductors and a lot of other things through the PLI scheme. I think we are in for an interesting time. I don't know whether some of these companies will hit the market in 2022, but over the next 2-3 years, we will definitely have some very interesting, innovative companies which we would be able to invest in.
One question, Sunil. Let's divide the market into 3 buckets: buy, sell, and hold. Simple question, bada aasan sawal. Buy, sell, and hold for 2022. In your understanding, what is a buy, what is a hold, and what is a sell or avoid?
So, first of all, I think Indian markets are always a buy for us. So to that extent, we are biased. But to answer your question, we will continue to believe that sustainable profit growth is a buy always. At this point of time, bubble in quality or quality at any price is definitely a sell. Along with some hyped new age companies, which are not bad companies, they are great companies, great entrepreneurs, but priced beyond perfection. And I think everything else will be a hold.
Great. So what is a New Year resolution?
New Year resolution is to be, always an investor. Try and keep peace. Try and be healthy. Have great friends like you and all the others. And, enjoy the fact that you are in the right country at the right time.
Yes, sir. आप एक practical resolution बताओ. ये तो theory वाला resolution है.
Sir, the financial resolution are all selfish resolutions, I was with friends a week, 10 days back to a great place in Uttarakhand. And, it is not about money which makes you happy. It is about being with people you love, people you like, which ultimately makes you happy. So I think the New Year resolution is always the same. Let all our friends, family be happy and healthy.
Well, that's what pandemic has taught us. Value of relationships and resilience. So really appreciate your time. Have a wonderful year ahead and fantastic performance. Touchwood is what I would say. And thank you is what I would say. Thank yous, I'm sure everybody's saying, those who've invested with you. Thank you very much.
Thank you, Nikunj, and thanks everyone at ET Now and all the viewers. Wish you a happy 2022.